it's a great honor to be here today talking about financial crises in the middle of a small one. I've spent 44 years of my career studying financial stability. The world has adjusted its financial regulation and supervision, and the finance industry has adapted several times. Yet nonetheless, the U.S. is having another banking crisis, albeit not as big a one as we had in the 1930s. So I'll try to give you my perspective on this today. So since financial stability is back in question, people are thinking about financial instability. Part of the point of a lot of the research that I undertook with Phil Bibbing, but also the stuff I've done by myself, is realizing that you don't want people thinking about financial instability. You want them thinking about something much more interesting, like what a beautiful day it is or something like that. And it turns out this is a global issue, and we'll see why something in Northern California could be affecting markets around the world. So why are banks at the center of this today? And I'll give you my perspective on what banks, or more generally financial intermediaries, which are a set of contracts that are written to augment what financial markets can do. I'll give you my perspective today on why banks are at the middle of this and how it relates to ideally what banks are supposed to do to make our society a better place. So I'm going to tell you about my research on the economic theory of banking, which again is financial intermediaries, not just commercial banks. And I'm a theorist, full disclosure, I'm a theorist. I look at the world, I read, the various financial newspapers, I talk to people in the industry. I don't put data and numbers into my models. So why would you ever ask a theorist for practical advice? I mean, if your plumbing is not working in your house, you want someone who knows how to fix the pipes, not who has some theory about why the pipes are leaking. So as it turns out, the models that I build, even though they don't have numbers, they're not that quantitative, they're a very good perspective to put into your head. And when you see something in the world that happens that surprises you, that's like not the way it's supposed to work, like a financial crisis, it gives you a perspective on why this is happening, which is useful to both plan in advance to help prevent it to some extent, and also if you're a policymaker or a manager, or just a consumer, to respond to that. So these models are very useful, and they turned out to be very useful in the recent past, the last month and a half, last 2 months. They were very useful in 2008. The U.S. Federal Reserve, central banks around the world, Ben Bernanke in particular, put these models into practice to see if they gave good guidance on how to respond, and it turned out that they apparently did. And then we had the week of the amazingly fast COVID financial crisis that was reversed by policies of central banks around the world. In that period, the models actually did pretty well. In addition, are these tests of the models? Well, they're not necessarily tests. There could be other models, other views of the world. I think of models as ways of distilling our ideas about how the world works and how the financial sector works and what it does. Are these tests? Well, they're not perfect tests because there could be other models which are true, but these did pretty well. And in early stages of a crisis, before you have much data, pretty much all you have is theory, which is essentially the distillation of looking at history in the past and trying to distill from past history and past policy responses how we want to think about organizing our thoughts. So early in a crisis, if you have theories based on the past, they give you the best you have in the present. And it turns out they did pretty well. So after I won the Nobel Prize last October, I had to give interviews more than I normally give. Normally I sit in my office and do research, but I was talking and giving interviews. So people asked me to predict the future. So it's very hard to predict the future. But what I tried to say was like, if something happens, then this other thing will happen. So what I was able to say is if the Federal Reserve persists in raising its interest rates unexpectedly fast, unexpectedly rapidly, in a period after they've been telling the world and the financial markets to expect low short-term interest rates for a very long period and gave the forward guidance that they weren't going to raise interest rates, when you violate people's expectations like that because you waited too long to raise rates and inflation starts to take off, you're going to have problems in the financial sector because the financial sector naturally has a maturity mismatch. And if they think interest rates are not going up, they'll have a much bigger maturity mismatch. So Raghu Rajan and I have been pushing that idea basically for the last 15, 16 years before they actually got into this low interest rates for a long period. So theory told us that this is where the problems are going to be. It was informed by the problems that we saw in the United Kingdom when in the gilt market, the long-term government bond market there, a few months before October. So it turned out that this view was more or less correct. And if you just say the obvious, you can see the future as long as the policymakers are willing to make mistakes, which they were at the Federal Reserve. So let me just give you a quick overview of the theories that I won the Nobel Prize for, and based on work of mine and with Phil Dybvig. They're basically, the Nobel Committee cited two of our models, the first two banking models that I wrote back in, started the first in the 1970s and the second one in the early 1980s. So both of them fit into the research program I followed throughout my career is what are the best possible contracts that financial intermediaries could write to improve the way the financial system works over and above what we can get from just having efficient financial markets. Financial markets where we can trade assets with each other, we can trade equities or bonds in the market, that's essential to have the financial system work well. But it turns out it can't do everything, and capitalism in its modern sense isn't just markets, but it's these contract structures, these intermediaries, these mechanisms that do better than just the financial markets. So what are the best contracts? It's like a why question. Why are banks or other financial institutions structured the way they are? What are the good things that it can do? What are the bad things that it can do? And then if you take that perspective, it turns out that financial crises just sometimes happen. They're very hard to get rid of. You can't get them without getting rid of everything the banking sector does. You can't completely get rid of them, but you can keep them. To a minimum. So it turns out that you don't have to be a bank to write these contracts. This is about the functions that the institutions are supposed to provide. You could be a shadow bank. You could be a bank, a non-bank like Lehman Brothers was. So the runs on Lehman Brothers wasn't because they didn't have enough cash in their vaults. People couldn't go and ask for dollar bills out of Lehman Brothers. The problem was short-term debt. And the point of our research is that short-term debt is the cause of financial crises. We'll see that in a few minutes. So what do banks and other intermediaries do that markets by themselves can't do? So I'll mention the two models. The first one was from my doctoral dissertation, Financial Intermediation and Delegated Monitoring. And what banks do there, I won't have the time to tell you the full detail, is that banks there are specialists in making certain types of loans to small and medium businesses or other businesses that need a certain amount of monitoring by the bank, by someone. It doesn't have to be a banker. It turns out it will be a banker. So if you don't quite understand the business, you don't quite trust the business, they don't have very good collateral. If you or I just lent money directly to that person, we wouldn't know enough to be able to profitably lend to them. They'd just be unable to borrow. But if they are monitored a lot, then they can borrow. And then it'd be really hard for all of us if we each lend them, 1,000 new Taiwan dollars. Yeah, if we each lent that little bit to them, we wouldn't want to spend any money monitoring them. But we can hire someone to monitor for us. That'll be a bank. They'll do delegated monitoring, and they can do the delegated monitoring. And it turns out that they have to hold a big portfolio of assets. They have to be very well diversified, and then they can finance themselves. These banks can that do the monitoring by issuing almost safe debt called deposits. But the key to turn risky loans that need monitoring into close to riskless debt that doesn't need monitoring is diversification. So diversification is the magic trick of this part of banking. So this is a little picture of a bank. So this bank is only diversifying across two loans, Firm 1 and Firm 2. and those magnifying glasses, that's sort of signifying the bank is monitoring what's going on in the firm. So they know what's going on in the firms. They could be monitoring loan covenants, telling them they're not supposed to do certain investments, and if those certain investments are necessary, the bank can waive that covenant and allow it to be undertaken. So the bank monitors the loans. These borrowers couldn't borrow without monitoring. Then there's that red line there, the red line across which no information passes. So the bank is monitoring the loans. The borrowers know what's going on with the loans. The investors don't really know. So the bank can't really share risk with those investors. Those people can't monitor the bank because it would be too expensive. Lesson one, depositor monitoring, even if deposits are uninsured, is nothing you should ever expect. When people say, oh, there won't be any more depositor monitoring if we bail out the uninsured depositors at Silicon Valley Bank. Well, there won't be any depositor monitoring if you do bail them out. There won't be any depositor monitoring if you don't bail them out. Depositor monitoring is not a feature of the banking sector. So how does the banking sector monitor risky loans and create riskless deposits? The obvious way, they diversify. So the bank issues pretty safe deposits. Why does the bank pay these depositors? Because if they don't pay the depositors, we get the magic feature of debt. If they don't pay the depositors, they fail. So maybe the depositors get bailed out, but think of Silicon Valley Bank. When they lost their funding because of a run, we'll talk about runs in a minute, the equity holders and the managers all got zero. So that is the way the system works. Pay or die. Pay or you fail. And why do you monitor? You monitor because you, the banker, get a bonus pool out of the equity, which is some fraction. That's how real bonus pools work. If the equity is zero, you don't get any bonus. If the equity is big, you get a big bonus. This works beautifully. So at a very abstract level, ask yourself the question, what's the best way to write a contract to delegate monitoring of loans? The answer is set up a bank. We're not trying to say, could a bank do this? We're saying, could anybody do this? If anybody was going to do it, they diversify and issue debt. That's exactly what banks do. So banks write optimal contracts, but this only works, as I just said, if the bank's diversified. The bank has to be large enough to diversify. It has to be diversified. So that's going to be a role for supervision and regulation. Because remember, the depositors don't monitor, even the uninsured ones. It's not in their skill set. But the bank supervisors can monitor the obvious stuff. And you have to make sure you're not too concentrated in any sector, as our chairman just said. They need to be diversified. And you have to make sure they're not too loaded up on economy-wide systematic risks. So you've got to make sure, even though they're going to naturally have a little bit of interest rate risk, you don't want them to be betting the entire bank on interest rate risk. That's not what banks are supposed to do in this thing. They're supposed to monitor loans to borrowers who couldn't borrow otherwise. Silicon Valley Bank had a bunch of U.S. government agency securities. There's no point in monitoring the U.S. government agency security. They're just going to pay you as long as the Congress doesn't do something stupid like not raise the debt ceiling. But they just raised the debt ceiling, so I wanted to add in that point. Okay, so that's the first thing to do. Banks monitor special loans. That's important. That's probably 50% of the value added of the banking sector. What's the other one? And this is the one that is more controversial. Banks create liquidity. So what that means is they create liquid deposits, which are safe and short-term and can just be cashed in on demand out of long-term illiquid loans. Why would the loans be illiquid? You can think of many reasons. It doesn't matter. Any reason that they're illiquid makes this model true, but think of the thing I just said of monitoring of special information about borrowers. If the bank knows the special information about the borrower, but nobody else does, if they sold that loan to somebody without the special information, that party buying the loan wouldn't be able to get the borrower to pay them as much because they wouldn't know enough to get the full payment out without foreclosing on the borrower. So if they sold the loan, they'd sell it for less than it was worth because it's worth less in the hands of a buyer than it is in the bank. That's a quick theory of why loans might be illiquid. So loans are illiquid for any reason. What does the Diamond-Dybvig model say? The paper was Phil Dybvig from 1983. It says what liquidity creation is sharing the risk of holding illiquid assets. A special type of insurance. It's insurance against the risk that you need your liquidity at a time when not everybody needs their liquidity. And if you really think at an abstract level without thinking about means of payment, money, demand deposits, think that's exactly how you create liquidity. We can take the notion of insurance that not everybody's going to need their liquidity at the same time, to say a bank or other financial institution that has lots of different types of depositors, I'll talk about the name for this in a second, can hold illiquid assets on a much better term than if we held them individually, because if any of us got the need for liquidity, for sure we'd have to sell that asset. But let's say only 20% of us are going to need that liquidity. We're only going to have to sell a little bit more than 20% of the assets in that case. So this is a type of insurance. So this shares the risk. That's what liquidity creation is. That's a little bit of a different, it's a lot of a different insight than banks create money and you can just pay your bills with them. They're both true and they're related, but it's not the same insight. Okay, for this to work, it requires diversified funding sources. I'll give you two notions of diversified funding sources in a second. So that's another thing that Silicon Valley didn't have. It didn't meet either of the notions of diversified funding sources. And the last thing is that this business of creating liquidity necessarily, unavoidably, almost unavoidably, there are a couple of tricky ways to get around it, almost unavoidably is subject to what I call self-fulfilling prophecy runs. The fear of fear itself runs, which is if everybody thinks the bank is going to fail because of a run, there'll be a run which will make the bank fail. Okay, so all of those things go together. Creating liquidity, the fact that you're subject, if you're a bank, you're subject to runs, and the fact this only works if you have diversified funding sources. Okay, so I'll tell you just in one line why creating liquidity in this sense and being subject to runs are the same thing. So the magic trick of banks is that banks allow the sharing of the risk of liquidating illiquid assets at a loss by giving those fractional people, those 20% of the people who withdraw, more than it could possibly give if everybody withdrew. So if only 20% of the money, 20% of the deposits are withdrawn, and you give a certain rate of return, that can be a higher rate of return than you can get if you took the portfolio of illiquid assets and liquidated all of them, because we're sharing the risk of liquidating some, and we can get a higher return than if we liquidated all of them. So that's how the trick works. We can create liquidity by doing this, giving those who withdraw more than we could give everybody who withdrew. Now the problem is if everybody withdraws, we can't live up to our contract. That's why the feature of banks, creating liquidity, and the threat of runs on banks, self-fulfilling prophecies of death are going to be self-fulfilling. Those two things are the same thing. They go together. Okay, so creating liquidity implies that a solvent bank, the paper Dybvig of mine, these purely to keep the point simple, not because it's true in reality. In that model, our little view of the world, if you hold the assets to maturity, you don't cash them in early, you don't liquidate them, they're completely safe, completely solvent. So if there's not a bank run, the bank is going to be beautifully solvent. So as long as we didn't have a bank run, the bank would never fail. But if everybody were to withdraw, because we're giving everybody more than we could give everybody, the bank would have to fail. So even with no solvency reasons, bank runs can cause unneeded bank failures. So we have to try to find a way to either do one of two things. Either keep people from fearing the fear itself, keep runs out of people's minds, having to think about the weather, having to think about what a beautiful, beautiful day it is. Those are good things to think about. Thinking about bank runs, that's bad. So there are two notions of diversified funding sources. First one is not all depositors need their money at the same time. If everybody's going to take their money out instead of 20% of the people, then we can't give them more than we could give everybody because that's just a logical contradiction. That's the first notion. The second one is depositors don't all see the same rumor or mistaken press report, or maybe even accurate press report that might cause a run. So let's say a newspaper was in a mood to be a little bit telling a joke, and they ran a headline that said, "Bank run today, story on page 2." So, and if you turn to page 2, this is a Chicago newspaper, it says, "The Chicago Marathon," which is a running race, "is today, and it's sponsored by the Bank of America, and it's known as the bank run." So you could imagine that would be a bad joke, and you say, you really hope everybody reads page 2, right? The trouble is, suppose you read page 2. you still might pull your money out of the bank. Why? Because you're not sure everybody else read page 2. So that would be a rumor that you knew for sure was wrong, yet nonetheless you got your money out of the bank. Okay? So if everybody reads that newspaper and they don't all have this wonderful sense of humor to read page 2 and say, oh, what? Nobody would think that would cause a run. You don't want all your depositors reading the same newspaper. Now, if you're in the newspaper business, you have a conflict. You want them all to read your newspaper here, so I should be careful in this audience. But in any case, you want diversified funding sources. You want different depositors to see different things. In fact, 40, 50 years ago, the big US bank, Citibank, had the idea that they should raise deposits in countries around the world. You couldn't diversify across different states in the United States at that point. So if you wanted diversified funding sources from different regions, you had to go internationally. Citibank was the only US bank opening branches around the world. This was part of the reason that they were doing it, because different people would be panicking in different amounts. And suppose only like 10% of the people read a given newspaper. So they see the story on page 1. Oh my goodness, there's going to be a bank run. They go page 2. It's the Chicago Marathon. They go, ha ha, that's funny. Only 10% of the people are going to read this. So even if they take it at face value and pull it out the money, no bank is going to fail because 10% of the depositors pull out. But if 100% of the depositors pull out, that's it for the bank. So diversified funding sources. The second notion says, in the modern terms, make sure all your depositors are not on the same social network. You want some of them reading Twitter and some of them reading something else. Okay. If they're all on the same social network and a rumor goes there, you might be in trouble. Okay, so diversified, so Silicon Valley failed both of these. It didn't have diversified funding sources of the first type because they were all startups in the high-tech industries. And they all needed their money at the same time as funding got reduced to those sectors. So it's like putting all your eggs into one basket, putting all your money into one industry. They didn't do that. And these startups were all in the same social network. So it's not a surprise that they had a run. So how can you stop runs even if these two things don't work? Keeping the confidence up and keeping the diversified funding sources there. So basically the government can insure depositors against loss. That one is the one thing that works well. It only works if the government stays solvent, and the government stays solvent because it can tax other people. It has deep pockets because it can pick the pockets of the citizens and businesses. So government is the only natural provider of deposit insurance. The other thing that could happen is you could just have the government truly committing and following through on that commitment to be a really reliable lender of last resort. Just lend to the banks without asking too many questions whenever there's a run. And that, if that's going to work, as long as the bank is otherwise solvent, that will stop the run from killing the bank. And the prospect of this, looking ahead that this will happen for sure, it'll actually stop the run from starting in the first place if it's based on a rumor rather than the insolvency of a bank. Okay. Why is this commitment important? So this is important because I'm going to talk about lots of mistakes made in the United States. Let me talk about a mistake made in the United States in the 1930s. The Federal Reserve Board did not lend to banks during bank runs in the 1930s. The Federal Reserve was set up in the 19-teens to lend to banks during crises. Then the members of the Federal Reserve thought there was too much lending to security investment going on, margin lending going on. So they decided, in the modern terms, there was irrational exuberance, to use Bob Schiller's phrase. They said, we're not going to lend to these banks. So nobody realized that at first, but once people realized the Federal Reserve was not lending to these banks, it caused nationwide bank runs, and it required a big banking holiday where the banks were closed for a week. Okay, so the government can't commit to lend as the lender of last resort. Then you need deposit insurance because that's contractual. Okay, so whenever I've given a talk to people who are not researchers in my area, I've always used a slide that has the first line up here. And the big takeaway from this work with Phil Dybvig is that private financial crises are everywhere and always due to the problems of short-term debt. It's not about bank deposits. It's about short-term funding, short-term debt funding, financing long-term illiquid projects. It's not because of interest rate risk. It's because of liquidity risk. If the loans are long-term and illiquid, and you finance them with short-term debt, if everybody thinks you can't roll over that short-term debt, you can't refinance that short-term debt, there's going to be a run. So runs are not limited to banks. It doesn't require a bank charter or handing out currency to be this. So we saw runs on money market mutual funds, both in 2008 and in 2020. We saw Lehman Brothers, which wasn't a bank. We saw stable coins like Terra and Luna and other ones more recently. We saw short-term securitizations, asset-backed commercial paper. So that was, all of those were about the problems of runs on short-term debt. The asset-backed commercial paper, if you took this view, you could see in early 2007, before Bear Stearns even went out of business, you could see that there was a run going on asset-backed commercial paper. It had this huge multi-trillion-dollar run-up, and it started shrinking very, very fast in the first month of 2007. And it fell dramatically. It fell like 60%. So it runs on short-term debt. That's where financial crises actually come from. So that's just full disclosure. Those are the models that I have in my head. So I'm going to tell you my view of the world based on those models. So what happened to the United States in this last March? So I'm going to focus on Silicon Valley because it's the most important one that caused troubles thereafter. So there was a mind-blowingly fast run on a Silicon Valley bank. It was a 2-day run, but it was really only a 1-day run. Because even though there was mobile banking and things, if you're a big, and their average deposit was between $10 million and $100 million. So they had very big deposits because they were business deposits. Even if you're a big depositor, the way you get your money out of the bank is you tell your bank to wire the money out. So bank wires, and bank wires are not real time. You ask the bank and then some person actually wires it out. So on day one of this run, which was a Thursday, lots and lots of people wired money out. They couldn't get through to the bank. On day two, even more people asked to wire their money out. But during the day, rather than wiring that money out, the bank failed. The regulators stepped in and failed it. So it was really a 1-day run that would have been even more devastating if it had turned into a 2-day run, because in the 2 days, those wire requests were not granted. Okay, so all of a sudden, people are thinking about bank runs. There haven't been bank runs for a good while. People thought the economy was doing well. People thought that Dodd-Frank, which is our regulation bill, was so great. I didn't think it was so great. So the runs spread to other mid-sized banks. So First Republic Bank was another Silicon Valley bank. Interesting personal story. My daughter lives in the Silicon Valley. She's a professor at a university around there you may have heard of. And she called me up on the Thursday, the first day of this. I was actually coming in from an airport, on an airplane. She said, "Dad, should I take my money out of the First Republic Bank?" I said, "I'm pretty sure you don't have $250,000, which is the amount of deposit insurance there." I said, "Why would I put $250,000 in a bank? I mean, that'd be crazy." Sorry for the banker here for saying that. She's an economist, right? So, okay. And then I said, "No, you don't have to worry. If the bank fails, you won't even notice it. If you're paying your bills, it'll be the same routing number. Nothing will happen. By the way, what interest rate are you getting?" Well, 0%. So now that is a mistake. Put your money into a certain money market fund that pays 5%. So, oh, that's a good idea. So my daughter participated in the run, not because she thought the bank was going to cause bank failure was going to cause her any losses. She realized, she woke up, that she wasn't getting a market interest rate on her money. And the runs not only caused people to think about failure, they caused think about, boy, am I been lazy getting 0% when I could get 5%. Hold that thought, because I'm going to argue that the Silicon Valley run was about solvency based on interest rate risk. It was not. Despite my great love for fear of fear itself runs, it was not a fear of fear itself run. It was not a Diamond 1983 run. Too bad, but phase 2 fits our model. So what's special about them? Over 60% of Silicon Valley's assets were in medium-term, very liquid, not illiquid at all, U.S. government agency securities, basically mortgage-backed securities from Fannie Mae and Freddie Mac. Okay. And interest rate increases caused the actual true market value, not the illiquid fire sale value, the true market value of those assets to go down. They had around 6-year maturity assets. Interest rates went up 500 basis points. Those assets, the real market value of those things goes down. As a result of the run, Silicon Valley failed, on a Friday, and they didn't make any announcement on Friday what they were going to do. Over the weekend, they tried to get somebody to buy Silicon Valley. They didn't succeed. So instead, the U.S. Federal Deposit Insurance Corporation decided to guarantee all the deposits. They nationalized the bank when they failed it, and the new nationalized bank paid off all the deposits, not just the ones up to $250,000, but we'll see, they didn't really have any small deposits at Silicon Valley Bank. They guaranteed them all, and then banks around the world start to worry about runs after the failure, but people worried a little less after they did not impose losses on the uninsured depositors. People worried a lot, says, oh, depositors will never monitor again if they bail out the depositors. I said more, depositors don't monitor. It's like it's asking you or me to keep track of the space program of all the countries in the world. We don't have any clue what they're doing. We just hope they don't crash, their vehicle, their spaceships the way Elon Musk did. And that was on Elon, it was not on us. So banks around the world start to worry about runs. This is not that small an event, as it turns out. So this is measuring the value of assets of failed banks as a fraction, as a percentage of then current gross domestic product in the United States. So if you look here, see if this pointer's working. There's that button. I'm always afraid to push the wrong button. If you look here, this is the current one, Silicon Valley Bank, Signature Bank, and First Republic. It's a little over 2% of gross domestic product. All of the great financial crisis in 2007 to 10 was only 2.5%. And the savings and loan crisis, which was over 2,000 failures, that was one caused by interest rate risk, because savings and loans made 30-year mortgages and financed them with overnight deposits. So that was almost exactly like the Silicon Valley Bank, except that was within insured deposits instead of uninsured deposits. That was only around 3%, right? So this is a big deal. It's not as big as the Great Depression, thank goodness. But the Great Depression went on for many, many years, and it slowed down world growth and employment in an unprecedented amount, and many people thought that was going to be like the end of capitalism. So we'll see. This is not, even though these are not the big banks that you had heard of, in terms of just fraction of GDP, it's a lot. Okay, so let me tell you about Silicon Valley Bank. The first thing is they were rapidly growing. Their assets more than doubled between 2019 and 2021. So I used to work when I was in graduate school, I had a summer job at the Federal Reserve Board in Washington, D.C. And the man with the office next to me was in charge of predicting bank failures. And most people have thousands of variables, they put them into regressions and do econometrics. What he did is said, yeah, you can do that, but the only thing you really look at is rapid growth. If a bank is growing very rapidly, they're probably cutting corners, their management controls are breaking down. If you see a bank growing rapidly, you should be really worried. Okay, so that's the first lesson the supervisors in the Federal Reserve Bank of San Francisco should have noticed. This thing going up so fast probably meant that they were doing something somewhat crazy, as they were, it turned out. The second thing is, when they passed 100 billion in assets, they get more stringently regulated. They get more competent regulators put on them, who have more advanced degrees. They have to pass more tests. But it turns out, when you pass 100 billion, you get 2 years to sort of get up to speed with the new, tougher regulations. So by 2 years after they passed the boundary, they had already failed. So that was another mistake. It's like, look, if you're small, we don't worry about you too much because we don't really care if you fail. You get bigger, we care if you fail. But if you're getting bigger, we'll start to care about it over time. So that was another huge mistake. And there was another thing that I don't have good evidence on, that the previous vice chair of the regulation of the Federal Reserve, Mr. Randy Quarles, had told the supervisors around the Federal Reserve System to make sure they didn't use discretion. They looked at the formulas they were supposed to enforce and enforced those, because their job, in his view, was not to think about whether banks were going to fail, but to use the regulations that the lawmakers had passed and enforce those. So we're going to see that the laws that the lawmakers passed had some problems. Okay. The other thing is that 94% of the deposits of the Silicon Valley Bank were uninsured deposits. Their average size was between $10 million and $100 million. So that's essentially uninsured. The first 250 is just rounding error. So 94% are uninsured. And another bit of the regulations that we had in the United States was based on the worldwide standards of the Basel Commission. They had something called the net stable funding ratio. You had to have a certain fraction of your funding in stable funding that isn't runnable. So one of the things that was assumed not to be runnable were checking accounts of any sort, insured checking accounts or uninsured checking accounts, demand deposits, payment accounts. Well, it turns out that most of the deposits in Silicon Valley were payment accounts, and they were 10 to 100 million in size. Those were treated as stable during a run. The only stuff that was unstable were what we call certificates of deposit, sort of like 3 months or 6 months things that actually pay high interest rates. Those are unstable, but we assumed that all checking accounts were sort of sticky. It was sort of hard to change banks. Well, if you're just panicking, it's hard to change banks. But if you're thinking your bank is about to fail, you'll go ahead and change banks. Okay, so that's another mistake. U.S. supervisors didn't mark Silicon Valley's government securities to market. So if you look, when interest rates increase, that makes banks insolvent at market value. They were insolvent, we'll see in a second. And this encourages banks to take on interest rate risk. Okay. If you're insolvent at mark to market, but your government capital requirement, let's say 10% or 5%, is not incorporating unrealized losses marking to market, you can be insolvent, but the regulators won't tell you, supervisors won't tell you to raise any more equity. So that's going to say, okay, you're not going to raise any more equity as long as, no, I don't have a run, I'm fine, because as long as I can keep borrowing at 0%, I'll be fine. But this mark-to-market value is disclosed to investors and depositors, and they're going to say, by the way, we're insolvent, but not on book value. So, oh, you're insolvent, I'm going to take my money out. That's what happened at Silicon Valley Bank. So here's if you look at, they have a very unusual setup for a bank. Not mark-to-market securities, government agency securities, were 55% of their total. Loans were only 35%. So this bank was barely a bank. This was like a small hedge fund or something like that. So the book equity in the end of 2022 was $15.46 billion. And unrealized losses, if you look there, it's around 17 or 18 billion dollars. So they're actual. Right before they failed, they released a thing called an 8K. It's a Securities and Exchange Commission form that announced they were going to try to raise some equity later. But by the way, you read the footnotes, were insolvent. That's what caused their run. So what's the point of not marking to market? Why would anybody ever do this? For illiquid assets that don't have good market values, that might be selling at fire sale prices, it makes some sense. It makes no sense in the world for government securities. So it's counterproductive because it makes depositors worry that here's a bank that's insolvent, but the regulators are giving us a thumbs up. Not a good thing. So banks don't make value add. They don't do anything useful by taking big unhedged bets on interest rate risk. The U.S. government agency is going to pay whether or not you monitor them. It's up to the Congress. Large interest rate bets are not diversifiable. That's what Banking 101 is about. So phase one, there was a fear of insolvency. People learned that this bank was insolvent from the 8K. Mark to market, so is that really relevant? Like they say, well, as long as we can hold these assets to maturity, we don't have to sell them. Why does the fact that we're insolvent matter? Well, if you can hold them to maturity and your cost of funding doesn't go up, it doesn't matter. But when interest rates go up from 0% to 5%, you're going to behave like my daughter did. You're going to say, I'm going to only leave my money in the bank if they're paying closer to 5%. That will make the deposit thing fail. And there's something called the deposit beta of how much interest rate has to pass through. Then, it's not zero. Then the second phase, and this is the fear of fear itself, once people are thinking about runs around the world, you're in a little bit of trouble. So more generally, this is the fear of future illiquid asset fire sales at other banks. Or it could just be an increase in the deposit beta, which is to say if interest rates, even if they stay the same, maybe more and more of those will get passed through to funding things. Social networks were blamed for this. Social networks made it go fast, but social networks are not like newspapers with a false headline. So social networks are sort of two-way communication devices. So if every startup agreed there's going to be a run on Silicon Valley Bank, but look, they're fine, it would be stupid to run, all of the startups, Peter Thiel and all the venture capital firms would say, leave your money in there, as long as we all leave our money in, we're fine. That was not Silicon Valley. Listen, these guys are insolvent, even if we all leave our money in, be stupid to leave our money in. So insolvency is a great thing to run. So there are lots of great things to run. Money's been coming out of banks into money market funds. Over $80 billion has been borrowed in very expensive funding from the Federal Reserve. So what should the world conclude from this? Should we conclude that any bank will be run and will be run? No, we shouldn't. Should we increase deposit insurance to infinity? Probably not. It might pay to raise it a little bit. But if you had all deposits insured, the only source of discipline on the banks would be the supervisors. Supervisors, we see, are not that wonderful in the US. Maybe they're better in Taiwan, but if you just had 100% deposit insurance, the only source of discipline would be, the only reason a bank would fail is because the supervisor said it was going to fail. The nice thing about bank runs, when the supervisors have not done their job, is the bank runs discipline not just the bank, but it disciplines the supervisors. Supervisors are, if you want to read some embarrassing things, read the Federal Reserve's report on the stupid things that they did. They blame it on the previous administration, but they basically said they made a mistake. So bank supervision is inadequate. The big point is market value should not be ignored. I'm from the University of Chicago. Financial markets are important. Financial institutions compete with financial markets. They add to financial markets. But for securities like liquid government securities, ignoring those market values is stupid. Is bank's basic structure a problem? No, it isn't. It's basically because the fundamental things that banks are supposed to be doing was not followed by Silicon Valley Bank. That's how we got into trouble. So later in the Q&A, I'll talk a little bit about what this has to do with Taiwan, but those are the basic principles, and we hope that your country does better than my country. Thank you very much.
Thank you very much.